Hello, and welcome to What's the Deal, our investment banking series on JP Morgan's Making Sense podcast channel. I'm your host today, Amaury Guzman, from JP Morgan's Leverage Finance Desk. I am thrilled to welcome back Brian Tramontozzi, JP Morgan's North American Head of Leverage Finance Capital Markets. Brian, welcome back.
It's great to be here.
Let's dive right in. A lot has happened 6 months into the year. We've seen rate cutting expectations adjust significantly from around 6 for 2024 at the beginning of the year to maybe 2 towards the end of this year. We've seen inflation continue to run slightly higher than what the Fed would want, as well as a strong and tight labor market, which has kept growth mostly on track with market expectations. On the back of this, we've also seen primary debt markets roar back to life. How do you view market activity for high-yield bonds and leveraged loans versus 2023?
Well, Amaury, it's been a fantastic year so far for leverage finance. In high-yield primary, we've seen roughly $150 billion of issuance so far in 2024, roughly double the period volumes from last year. The asset class has seen positive mutual fund flows versus outflows last year. Secondary performance has been strong. The JP Morgan High Yield Index currently sits at 7.96 versus the average in 2023 of 8.71. So we've had about 75 basis points of yield tightening versus the average of last year. Most notably, however, high-yield spreads are at 15-year tights.
Right, that's very interesting. Now talk to our listeners about the leveraged loan market.
For primary activity in leveraged loans, we've seen $640 billion of borrowing year-to-date versus $125 billion same time last year, over a 400% increase. Another way to punctuate the froth of loan calendar, almost 40% of the entire outstanding loan market has an effective date in 2024. CLO creation in 24 has been stellar, with $90 billion issued, double that of the same period last year. We've seen $12 billion of inflows into leveraged loan funds in 2024 versus outflows same period last year of $14 billion. In secondaries, about 57% of loans are still trading above par. That compares with 39% at the end of 2023. And at that time, we were saying 39% is still a healthy level. It is important to note that of the $640 billion of leveraged loan primary volume so far this year, over half of it has been for repricing purposes, reflective of borrowers taking advantage of the strong secondary performance of leveraged loans to reduce interest expense.
So it's clear that activity in the leveraged loan and high-yield bond market has had a strong pickup so far this year. What do you view as a catalyst driving primary and secondary market action?
I point to a couple factors. From a fundamental perspective, the economy remains reasonably healthy and inflation is moderated. But I think the real strength for leveraged loans and high-yield bond markets is the technicals. Investor and lender cash balances are very healthy on the back of the strong cash inflow into high-yield bonds and leveraged loan funds we've mentioned earlier. 85% of the primary volume of high-yield bonds and leveraged loans has been for refinancing purposes, including repricings, effectively just recycling investor and lender exposure and not eating into investor and lender dry powder. Lastly, while we've seen some green shoots in M&A, activity remains subdued versus normal volumes. The supply-demand imbalance is reflected in that 15-year high-yield index spread low of 350 basis points versus the 15-year average, which is 550 basis points. We're trading 200 basis points inside of the norm.
So pivoting away from the recent performance and focusing on the outlook, there is approximately $1 trillion in leverage credit scheduled to mature through the end of 2027. What would your message be for those issuers and borrowers currently on the sidelines or monitoring the markets for a window of opportunity?
Market conditions are very supportive for companies looking to refinance near-term maturities. At some point, M&A activity will rebound. However, at the moment, the forward M&A pipeline remains light. Only $38 billion, split about 2/3 loans, 1/3 bond. When more new money financing comes, it's not unreasonable to expect spreads to widen. Maybe not fully to the long-term mean, but it's certainly a risk.
Brian, as we sit here today and look to close the first half of the year, what are you keeping an eye on and its potential risks to the outlook?
I'm focused on a wide variety of factors. First is healthy economy. Spreads reflect default risk. Any meaningful negative change in economic outlook will weigh on loan and bond spreads. Second, I'm looking at inflation data. Benchmark interest rates are taking a lot of direction from CPI, PPI, PCE, employment, and other data. Third, I'm also looking at M&A calendar growth. Spreads are a reflection of supply-demand balance. If M&A volumes surge, then spreads are likely to widen. Next, I'm focused on funds flows. CLO creation has been incredible so far this year in the loan market. Any change to the activity will weigh on demand. And then finally, geopolitics can swing sentiment dramatically.
Thank you, Brian. Interestingly enough, in Jamie Dimon's annual shareholder letter, he also voiced concerns about the wider range of potentially adverse economic outcomes that could come from sustained periods of higher inflation and governments having to address a combination of geopolitical conflicts, higher debt balances, loose fiscal conditions, and the impact from unwinding QE programs. So there are a lot of factors that you and Jamie are looking at, setting the stage for what will likely be an interesting back half of the year. But I think we're towards the end of our allotted time here. So thanks again for taking the opportunity to sit with us to get your views on the leveraged loan and high-yield bond markets. And we look forward to having you back with us again soon.
Thank you for having me, and great job in your first podcast.
Thank you, Brian. And thank you to our listeners for tuning in to another episode of What's the Deal? I'm your host, Amaury Guzman. Until next time.
Thanks for listening to What's the Deal? If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, and YouTube. To stay ahead of the curve, sign up for JP Morgan's In Context newsletter, packed full of market views and expert insights delivered straight to you. To subscribe, just visit jpmorgan.com/in-context. This material was prepared by the Investment Banking Group of JP Morgan Securities, LLC, and not the firm's research department. It is for informational purposes only and is not intended as an offer or solicitation for the purchase, sale, or tender of any financial instrument.